Gargi Chaudhuri is Managing Director, Chief Investment and Portfolio Strategist Americas at BlackRock, and she's with us here in our studios to take us through what she's making of this entire situation. Gargi, great to have you with us in the program. Thank you very much for your time. We've had guest after guest, and we've been talking about this general sense of calm in markets, largely unbothered. Oil prices are up small, equity markets, of course. They're not the first port of call when you have things like this. It's oil, but it's not showing up in oil in any big way as well, what's happening. And we were also wondering earlier, it's not showing up in bonds, it's not showing up in the dollar, which are traditional safe havens. What do you make of it, the market reaction?
Not even in gold. Looking across asset classes.
Right.
It's just almost BAU.
Yeah, so good morning. Thank you for having me. And absolutely, to your point earlier, it's been a little alarming to see the news headlines, obviously. But at the same time, when you look at price action in markets, I think they're telling us something. And I think what we should take away is that historically, geopolitical events, as hollow as it sounds to say this, obviously from a human impact, historically, they have not had a longer-term, sustained impact on equity markets. So when you look back 20 years, 5 years, 3 months, all of the geopolitical events that we've had, if you look at the US global equity market response a month or 3 months out, you've seen that geopolitical events have not really had a role to play. So I think what we're seeing now is just a much more efficient version of that. The markets aren't even really doing the initial sell-off in a meaningful manner. They're looking ahead to earnings, which are robust, financial conditions, which are pretty supportive, especially in emerging market economies where there are rate cuts abound. And in the US, I think the market's looking ahead already to this idea that earnings still remain very, very solid. And once again, we think geopolitical events will eventually be looked through by the markets. I will take a little bit of the other side on your point earlier, Prashant, that you made on oil prices. A little bit more muted, especially after the weekend news. But if you look back from May, we have had a significant jump. So that 26% or so rise, that's not nothing. And I think that's the big event that the market's going to react to, especially if there's anything that happens with the Strait of Hormuz in the weeks and days to come.
So, I mean, given what you've said, what the previous speaker is saying, it just kind of reminds us, and it's good to sort of have that, that there is no immediate corporate impact, no immediate financial impact, and that explains the market's reaction. So can you now expand on one of the points you made, which is robust U.S. growth in corporate earnings?
Yeah. Because
there, the one sword that's hanging is tariffs. Now, in the midst of all of this, we've forgotten that we're very close to July 9 as well, right? But we're there. And we don't know what those final tariffs are like and what the implications of that will be. Your thoughts?
Of course. So there are a couple of things here as well. So number one, there's already been a significant amount of tariff de-escalation. And I think the markets have absolutely responded to that when you look at the price action from the beginning of April to basically now. We were sort of getting to a point where expectations of tariffs was in the mid-20s. Right now, that's landing somewhere. The landing zone is, call it between 10 and 15%. Significantly higher than where we were in 2024. But given what we had sort of thought it might be, it's still, there's been some de-escalation. While that's been going on, I think what the market should pay more attention to is that corporate earnings have actually been a lot stronger. So when you look at Q1, and obviously Q2 is upcoming, but when you look at Q1, earnings growth was almost double of what was expected. And that the diffusion index of that was very broad. That came across, it wasn't just the Mag 7 names. It was across different sectors. And I think that alongside the fact that many investors have been over-allocated to cash, have been sitting on the sidelines because they've been nervous about this volatility as a result of geopolitical risks, as a result of tariff risks, uncertainty around future fiscal policy. Some of that money is beginning to move back into US and, frankly, international markets, which is another big theme that we've begun to see for the course of 2025. So earnings have been strong. Growth weaker than 2024, but we're not looking at a recession in the US anytime soon. And at the same time, we have a Fed that's sort of signaling that they're still willing to entertain about 2 cuts this year.
All right. Hi, Gargi. Good to have you in the studio.
Great to be here.
A quick point with regard to Brent crude prices. It's spiked up, as you said, by $15. At what level will become a bit of a worry for India? Because, normally if you saw such a big spike, Indian markets would have been rogered. That's not really happened this time around. So at what point of time do you think it's a worry? And the second part is on the dollar index. Consensus seems to be suggesting that the dollar index has made a near-term peak and will correct from here on. What's your take?
Sure. So I'll talk about oil prices first, of course, especially as it pertains to Indian investors. So I think that it's not the level it touches, but the sustained amount of time that it can stay there. So obviously, if we have this left tail event of the Strait of Hormuz getting shut down, we all know that's 20% of global oil supplies. India, China, Europe being countries that are net importers of oil, of course, that's going to be GDP and consumption hampering. Yes. But the question is, how long do we stay at those $75, $80, $100 levels? If we stay there for a period of time, that is where it becomes a consumption worry. If it touches there and then, it shuts down and then reopens, if it touches there, but then it de-escalates very quickly, I think that's going to be quite a different outcome. So I think both are important. Obviously, the level, but more important than the level is the change.
Yes, okay.
And then the second point around the US dollar, I think there are two things to think about here. One is more around the medium-term impact. I think there are quite a few things that are pointing to a decelerating dollar trend. Number one, international markets being a source of asset allocation for our investors across the world again. To the extent that many investors were only thinking about US markets, this is a year that has shown why you need to be diversified globally in countries like India and Japan and broadly in Europe as well. So the idea of moving away from the US, and then I would say secondly, many international investors in the past that haven't hedged are now beginning to hedge more meaningfully. That is another pressure on the US dollar. So both of those, I would say, are driving and will continue to be a driving force lower. However, I want to be very careful as to what that may or may not mean for structural views. This is not about USD not being a reserve currency. If you look at 90% of FX transactions, 40% of global trade invoicing, about 70% of global payments, it's still in US dollars. So we're not losing the reserve status. This is more of a structural view or a cyclical view to slightly lower levels than here, because the dollar, even today, with the move year till date, is still an expensive currency. So I think we can see a little bit more of that.
There is also that inherent tension, right? I mean, the US and Trump administration wants the dollar lower, but they still want, in a way, the dollar to be right there, I mean, to be bought in adequate amounts. So, that inherent tension is there. I mean, that reserve currency point, I mean, that goes against the view that dollar should be lower, a lot lower. In a way, right? I mean, there is that.
Everyone should use the dollar, but the dollar should be lower.
Should be sure. So it's a.
I think it's balancing what you're trying to achieve. If it's trade deficit you're worried about, if it's budget deficit that you're worried about, I think it's thinking about all of those together and the role the dollar has to play. I will say there's a huge amount of focus on the unwind of US exceptionalism. So that's a narrative that's been out there, and you guys have talked about it. I think what's more important is what is the fragility in our fiscal policies in the US? What does that point to? And I think that's what the dollar is reacting to. If we're going to have a higher and higher fiscal deficit, can that support a stronger dollar? And I think that's why we've been telling investors a lot to stay away, in the US especially, from the very long end of the bond market. So I think that those are the ways in which it manifests itself.
Yes, what's the size of the US talking about? $50 trillion?
Yeah, a little bit more. But yeah.
I mean, it's a little bit moving out. I think it's going to be good for the rest of the world, maybe good for US as well. It kind of takes the pressure of US valuations, etc.
I think
it's not the end of exceptionalism. It's just maybe just some
exactly. It's a pause, and I think it's a good way for many investors, US investors included, to think about a diversified portfolio which has allocations to emerging markets, to Europe, and to US.
So everybody benefits. Okay, so let's talk about India. I mean, and what do you think of things happening here? Because I think since we last had you in the studio, the Reserve Bank of India has been very, very generous with the CRR cuts, with the repo cuts. And we were discussing this internally, that earlier when we would get a 50 basis point CRR cut, 100 basis point, we'd be like, oh my God, it's crisis time. So it's, RBI firefighting. But I don't know if this is a new age of monetary policy. Just your thoughts on how things are positioned
Yeah,
here?
absolutely. So the last time I was here in the studios about, I think 6 or 7 months ago, we were just discussing, one of the things that we talked about or had talked about was just the longer term appeal of India, especially for international investors, US investors that may not have had India as a source of diversification in their portfolios. And more so than ever now, with the pullback that we experienced towards the end of 2024, coming into 2025, especially now with the cyclical turn in earnings in US. I was just looking at some of the earnings revisions ratios now moving up in India, alongside with your point around the RBI giving us a generous rate cut and financial conditions as a result being so supportive. I think those are all great. You've got the valuations, which may not look incredibly amazing, but I think that's always been the case in India. But on the same time, you have a case for a role in the portfolio. You have flows that are turning. We're seeing international investors that had left the Indian markets coming back a little bit. So that's positive. You've got the fundamentals from an earnings perspective, and you've got the macro fundamentals just from RBI being more able to support perspective. So all of that, I think, is short-term great. From a longer-term perspective, the demographic story, the digitization story, we've talked about that at BlackRock a lot. I think those are really beneficial for the Indian markets. And we're constantly telling investors to think about India and China as standalone parts of your portfolio, as opposed to putting it all together as one EM bucket.
Okay, Gargi's making us feel good. The world, global equities, US, and of course here in India as well. So yeah, suddenly the missiles are not that frightening anymore.
Come more often, Gargi.
You would love that.
Thanks very much, Gargi.
Thank you.
Thank you so much for that.